Hey, this is Seth Peek with Peek Realty and Peek Painting in Atascadero, California. Once again, joined by my buddy Harry Bennet from Equity Reach Mortgage in Arroyo Grande.
Yes, thank you so much.
Coming at your weekly Tuesday lender and realtor update, infotainment, whatever you want to call it.
Yeah.
Topic of the week. What are
What
we
are we
talking
talking
about?
about?
What are we talking about? Well, we both know, so
Yeah.
that's a sneaky little lead in. We're going to talk about 2-1 buy downs, buying down your interest rate, making your mortgage payment more affordable for the 2 years, in the
Yeah.
initial 2 years. I'm newer to the idea of it. This obviously, as a realtor, it's not been the last 2 years hasn't really been used very often until maybe this last season, as interest rates have been going higher.
Mm.
Correct, right, Harry?
Yeah, I think you're, a lot of people they hear 2-1 buy down, they think no, like that just sounds dangerous. I don't It sounds like an arm, it sounds like something I don't know, it sounds like anything other than a fixed 30-year mortgage. So just stop trying to tell me about it because I don't want to hear about it. But really it's creative financing.
So even though you're the first question I thought I had when I was researching this conversation today is like, well, do you qualify for the loan at the, say if the loan's 7% for the 30-year mortgage, do you qualify for the 5% loan and then it creeps up to it, or do you have to qualify for the loan at 7% and then you utilize the 2-1 buy down?
Yeah, that's a great misconception because a lot of people think, well, then I'm going to qualify for the lower one. You actually are going to qualify at the note rate of origination. So if your mortgage is at a 7% rate for the whole 30 year, let's get this straight first, is that people think it's an adjustable or something like that. It's not. It's a fixed 30-year mortgage. That's how they're going to be originated in most cases. And if it's originating at the 7%, and you do a 2-1 buy down, it's only a temporary discount. So
Gotcha.
you're still going to be qualifying at the higher rate, or else it would be a toxic future.
Gotcha. Toxic future. That sounds like a
Mm-hmm.
science fiction film.
It would be a toxic future, and what would happen is that you'd get a lot of folks that would get qualified at 5%, but once it hits back up to its original qualifying rate, they would technically wouldn't be able to afford it at that point, right? Because it's gone
Right.
up, and so that's why they have to qualify at the higher rate.
That makes 100% sense. I mean, so the downside, well, what is the downside of a 2-1 buy down long term? If you're, because I guess it's a great fit for someone who thinks or knows that in the next 2 years they're getting incrementally more income. Maybe the wife is going back into the workforce by the second year.
Mm-hmm.
So maybe their income is going to increase so they can absorb the higher payment in 2 years. What's the disadvantage? I mean, does that track right? Like what people are that know they're
Yeah,
going to be
it
making
does
more money?
actually. And I had a client that was referred to me actually by you guys, right? And the
Oh,
client, right?
yeah.
And this all comes down from what options are you being presented by your lender, by your loan officer, right?
Sure.
Because sometimes you come in thinking guns blazing, that's the option I need, that's the option I want, I've already diagnosed and I want this. And you really need to take a look at it, because the disadvantage is that eventually, right? Let's just say we are in the lowest rate environment that we can get for the
Mm-hmm.
next 10 years.
Mm-hmm.
Let's just assume that, and it's only going to go up, right? The disadvantage of not using that amount of money to permanently buy your rate down from where
Mm-hmm.
we're at now, which you can get into the fives potentially, right?
Uh-huh.
With the amount of money
Yes.
you're for the temporary, that would be the disadvantage in my eyes, is that you're not permanently buying it down. You're just a temporary discount.
I guess that could be a disadvantage, or you could see it as like
Or it could be an advantage.
it's just a reality of what you're doing. So
Yeah.
the 2-1, is it, it's 2% the first year, it's 1%, it's the entire calendar years, it's 12 payments.
Yep. Yeah. So there's a technically there's three programs out there that I know of. There's a 1-0 buy down, there's a 2-1 buy down, and there's a 3-2-1. They're all the same thing. They just represent different years. 1-0 obviously is you're enjoying a discount for 1% for 1 year.
And so the savings that you have on those, well, 2% the first year and the 1% the next
Yeah.
year, it's amortized over the remaining 28 years. like the savings you have, or what's the?
No, you're going to enjoy the savings is going to be incurring in the first 1 to 2 years. So if you're doing
Gotcha.
that 2-1 buy down, let's say you get qualified at a 7% rate. That's the qualifying note rate for the 30-year
I
fix,
got you. Yeah,
right?
yeah.
Now, for the first 12 months, that's the number 2 that's going to play this part, right?
Yes.
Number 2 is the 2% off. So the first 12 months, first 12 payments, it's going to feel like a 5% interest rate.
Gotcha.
And then on month 13, it's going to go up by 1% to that 1, 2, 1. Now it feels like it's a 6% rate.
Gotcha.
And then on month 25, right, you're back at your original note rate.
So who qualifies for a 2-1 buy down? Is it a higher credit score? Is it a bigger down payment? Is there any of those factors that go into it? Or
no, they're going to follow standard underwriting. So it's going to be based upon it could be an FHA, it could be a conventional. They're going to follow the standard underwriting. So you still have to qualify for a mortgage, right? For whatever program you're going to go for. But you have to have the seller has to participate in that 2-1 buy down.
I gotcha.
Yeah.
I gotcha. I think that this is obviously, it seems like there's not a lot of obstacles if you're going to be buying a house and getting, if you're going to be getting a loan anytime in the next year or so, in terms of what obstacles do we have with these?
With the 2-1 buy down,
Yeah,
is that you have to have the seller like fund this, right? So they're going to set aside, $15,000, $18,000 sometimes, right, to fund that program. And so that's a lot, that's not like just a little chip off the shoulder there. Depends on the property.
Right.
But honestly, it's, like I said, I've had clients where they're like dead set on this. And I said, look, let's just take a look. Would you be open to, looking at a permanent rate where it's fixed? Maybe we fix it. Like maybe your rate today is 6.875, but maybe we can have a fixed 30-year for 5.875, right? So we take a look at both those options and weigh it out. But typically 2-1 buy down would be a really good option for someone who's a little bit more savvy in mortgages, and that somebody who is going to live there for, maybe a few years and they want to see what the market does. Gotcha.
Well, definitely a great option, especially with higher interest rates the way they are right now.
Yeah.
Thanks again. Looking forward to our next talk next week.
Absolutely.
As always, see you. Thanks, guys.
As always. See you, man. Take care.